But my next guest is a buyer even if tariffs go into full effect, as discussed, including on Mexico next month. Here to explain why is Paul Christopher, head of the Global Investment Strategy at Wells Fargo Investment Institute. Paul, we kind of set this up without meaning to as a he said. You got kind of a little bit more of the bearish case from Dean just there. And you're in the camp that says deregulation is going to override all of this. Really?
Well, I wouldn't say deregulation by itself, but if you take deregulation, tax cut extensions, which we think are very, very likely later this year, and the organic strength of the economy, the rate at which consumers are spending, especially on services which have not been tariffed, we think though that combination will pull the economy forward, and we would be buyers here, certainly, of the S&P 500.
Is the dollar the kind of story that is a market event? When I saw it at 110 earlier today, I mean, the euro's almost at parity, and you think, well, all right, good for consumers who want to travel, but maybe not so good for manufacturing exports. You know, that's kind of the whole point here, too. So, it's almost like tariffs are kind of a narrow issue, but a strong dollar becomes a pretty broad one.
The strong dollar is, as you say, it's a two-edged sword, cuts both ways. For importers, though, it does make the tariff a little bit more blunted, because if you're a Canadian supplier and your currency is weakening, but you're pricing in Canadian dollars, well, then the price that the American buyer pays for those auto parts, let's say, in U.S. dollars is now less than it was before, or less than it would have been. Let me say that. Less than it would have been. So the stronger dollar helps blunt the inflationary impact of the tariffs, which is one of the reasons why we're not terribly concerned about the inflation impact here in the next couple of quarters.
And you're sticking with large caps, which today in this little kind of stress test proved the most resilient. The Dow outperformed the Russell by like a full point during the worst of the sell-off.
Look, these are efficient companies. If you go back, for example, I was looking at tariff revenue the other day and noticing how tariff revenue in 2018 surged to a new high, an all-time high, at about 3% of federal revenue. But you know what? By 2020, it was back down to where it was before. My point in this is that companies make adjustments, and these large, efficient companies in the S&P 500 will make the adjustments eventually. We wouldn't get too hung up in the day-to-day of what your guests were talking about a few minutes ago in terms of, well, how do we know what to buy for summer or fall? That will resolve itself. You'll see some volatility in margins, but we think the secular trends of infrastructure building, reshoring, and artificial intelligence, along with the mitigating factors that we mentioned, like the currency, the dollar being stronger, and some of these companies in Canada maybe being willing to absorb the cost in their own margins, that will help offset here. So you'll get some volatility in margins, but we would look through that and still buy industrials here, and we would still buy large caps and energy. We had this as part of our outlook in December of last year. We're sticking with it.
But it's fascinating that you said, basically, I'll kind of read between the lines you laid out. Once companies have to pay tariffs, they find a way to not have to pay tariffs. You know, they obviously make supply chain moves or otherwise. So that might be reassuring for me as an investor. But what about the whole idea from the politics of this, which is that tariffs are supposed to raise revenue? Tariffs are supposed to reshape supply chains and so forth.
Well, tariffs do raise revenue, but at 2% of total federal revenue, we'd have to consider that kind of a minor source. We wouldn't expect that fiscal plans can be unlimited for spending and further tax cuts beyond the extensions that we're expecting. We wouldn't expect that, because then you'd have a much larger deficit, and then we'd worry about bond yields, which is where our focus is in terms of risks this year, not tariffs.
All right.